Hi there, welcome to yet another episode where we take a deep dive into the macroeconomic and fixed income dynamic segments for the third quarter of 2023. My name is Stellah Swakei, your analyst at Standard Investment Bank. During the quarter, the National Treasury released the draft budget review and outlook paper, citing that the Kenyan economy is expected to expand by 5.5% in 2023, mainly supported by a strong rebound in the agricultural sector, and this is following the relatively good rainfall that was experienced in most parts of the country. However, there's a downside to the rainfall as there's expectations of El Nino in the remaining quarter of 2023, which might have an effect into the harvest season that is currently ongoing. The year-on-year inflation retreated back to the CBK's target range of 2.5% to 7.5%, coming in at an average of 6.9%, lower than the 7.9% and 8.7% that was recorded in the second quarter of 2023 and third quarter of 2022. The performance was mainly on the back of lower food prices following the harvest season, which led to lower prices of grains in the market. On the downside, the private sector business environment remained in the contraction zone as backed by the SIB Purchasing Managers Index, which came in at an average of 48 during the quarter. The index was heavily weighed down by lower customer demand, primarily due to cost pressures, which were occasioned by higher electricity and fuel prices, as well as a weakening currency. Notably, the Kenyan shilling lost around 5.4% to the dollar quarter on quarter and 22.7% year on year as dollar demand increased amid scanty inflows. On the fixed income front, yields on all government papers extended Q2 increases, but yields on shorter term papers and longer term papers increased at a faster rate than medium term papers, causing an inversion on the yield curve. The stance reflects higher borrowing costs for the government and more unrealized losses for investors with older bonds. Central Bank of Kenya introduced measures aimed at addressing the high volatility in the money market, ensuring that the interbank rate closely tracks the central bank rate. T-bills and T-bonds were oversubscribed, but activity in the secondary market significantly increased as investors moved their available for sale portfolios to held-to-maturity portfolios to potentially reduce their mark-to-market losses. For more information and analysis, please see our quarterly report.